Hello, I am Ram Shivakumar. I'm a professor, writer, and investor. I've been teaching courses on economics and strategy for MBA and executive MBA students at the Booth School of Business at the University of Chicago for 22 years. For the last decade, I followed the practice of sharing a weekly email update with my current students. In each email, I highlight a few events and news items from across the world that are of relevance for anyone interested in economics, management, and public policy. I'm going to now share this update with you on my YouTube channel. So here's the first of what I hope will be many such videos. In today's video, I will discuss a few news stories that caught my eye over the past 10 days. I will also briefly discuss a few articles that I've read and that I've liked. The first news item is one that has been a front page news event for the last few weeks. The rapid rise of the S&P 500. The index that tracks the performance of the 500 largest listed companies in the United States. Many articles reflect the mood of investors, bullish, elated, but also concerned because markets have grown so fast. Are these valuations sustainable? What could be the catalyst for a meltdown? Take a look at this figure of the S&P 500 over the last 10 years. As of March 12, 2024, the S&P 500 is approximately 25% higher than it was in October 2023. That was just 5 months ago, and 125% greater than at the beginning of COVID-19 in March 2020. That stock prices are at these levels and have gotten here so fast is remarkable when one considers the headwinds. Inflation is still at 3% plus and interest rates are still high. Furthermore, the US is in a trade war with China, the second biggest economy in the world. One view of today's markets is that they're in a bubble and that it won't be too long before they pop. An indication that valuations are high is reflected in the cyclically adjusted price to earnings ratio, also known as CAPE or the Shiller PE ratio. As of March 12, 2024, the CAPE is at 34.61. Not as high as the 44.2 that it reached in 1999, shortly before the dot-com bust, but higher than it was in 1929 before the stock market crash. An alternative view is that market prices are reflective of economic realities. The US economy is strong. Real GDP growth in the third and fourth quarters of 23 were 4.9% and 3.2% respectively. Furthermore, investors are buoyed by the potential of AI to jumpstart productivity. Unlike the dot-com companies of the late 90s and 2000s, Nvidia, today's hottest company, actually makes a profit. Indeed, while Nvidia's stock price has increased 5-fold over the last 18 months, its earnings have been just as impressive. In the last quarter of 23, Nvidia's gross profit of $17 billion was more than 5 times greater than quarterly profits 15 months earlier. The other members of the Magnificent Seven, Microsoft, Alphabet, Amazon, Google, Meta, and Tesla, are also in positions to dominate their sectors. America's gurus believe that the good times cannot possibly continue. Warren Buffett, the sage of Omaha, believes that there is no possibility of supersized returns, as was the case over much of the 2010s. And Lawrence Summers believes that we're at the foothills of a bubble. Having been scarred by the dot-com bust of 2000 and the Great Recession of 2008, I remain watchful. The thing is, staying in the market leaves one vulnerable to crashes. But staying out also means that one can't benefit from recoveries. As is true in many aspects of life, luck may be just as important as skill. My second story is about a car manufacturer that many of you will likely not have heard of. I'm talking about BYD Auto. BYD Auto is a Chinese automobile company. It made news headlines a few weeks ago when it overtook Tesla to become the biggest electrical car manufacturer in the world. BYD Auto was incorporated in 2003 in Xi'an, China, by an entrepreneur Wang Chuanfu, following the acquisition of Xi'an Qinchuan Automobiles. Its first car, the BYD F3, a plug-in hybrid car, was introduced in 2008. And its first battery electric vehicle, FD3M, was introduced in 2009. BYD Auto sold more than 3 million cars worldwide in 2023. It is the dominant automobile company in China today. What prompted me to talk about BYD Auto is that it is employing a strategy straight out of Alfred Sloan's playbook. When Alfred Sloan was appointed as president of GM in 1923, Ford was the dominant automobile company. GM was a distant second. Sloan decided that GM would build different cars for different segments of the market. The Chevrolet division would produce cars for the price-sensitive customer. The Pontiac, Oldsmobile, and Buick divisions would produce cars for increasingly higher willingness to pay customers. And the Cadillac division would produce cars for the premium customer. By the time that Sloan retired as chairman in 1956, the portfolio strategy had paid off. GM was the biggest as well as most profitable car company in the world. BYD Auto seems to be following Sloan's script. Starting from the entry-level segment, it has started to move upmarket by offering premium and luxury cars. Its latest offering, the Yangwang U9, is an electric sports car and is priced at approximately $230,000. It has also expanded the range of offerings in the hybrid segment. Its Qin Plus DMI hybrid car has a price of about $11,000, considerably cheaper than Toyota's hybrid cars, and competitively positioned against the gas-powered cars produced by Toyota and Volkswagen. One should judge BYD Auto's a car for every segment strategy by how the portfolio rather than the segments perform, and it may take several years before a definitive conclusion can be reached. A remarkable stat that I read this past week was this: almost half of the world's population is expected to be obese by 2030. In the US, almost 2 out of every 3 adults are already obese. Not surprisingly, there is a thriving market for weight loss drugs. What I read is that weight loss drugs are finally beginning to work. Clinical trials are showing that drugs can reduce the risks of heart attacks and strokes. The dominant players in the weight loss segment are Novo Nordisk and Eli Lilly. On the back of its blockbuster drug Ozempic, Novo Nordisk market capitalization has almost doubled to $600 billion in the last year. And riding on the wave of success of its weight loss drug Zepbound, Eli Lilly's market cap has soared from $313 billion to $717 billion in the last year. This market is going to get more crowded as more than 50 pharmaceutical companies are running clinical trials at this time. A news item of note: evidently the enthusiasm for stock markets and investing is growing in India. The Economist reports that the number of individuals registered to trade has grown from 31 million in 2020 to 90 million at the beginning of 24. Investing has become easier for several reasons. It takes minutes to open an account and complete a trade. An estimated 600 million people in India now have smartphones, and investing has been heavily promoted by the mutual fund industry. It helps that the Indian financial markets are trending upwards. But how will these investors react when markets go south? That is the question. I want to close with a brief summary of articles that I read recently that may also be of interest to you. I'll place links to these articles in the comments below. Please note that some of these links may be gated. The first article that I recommend is about Oppenheimer. I'm not talking about the movie that won 7 Oscars a few days ago, but about Robert Oppenheimer, the manager. Ben Cohen has an excellent article in Saturday's Wall Street Journal on Robert Oppenheimer's managerial practices. When Oppenheimer was chosen to lead the Manhattan Project, the project to develop the atom bomb, he was 38 years old. He had no managerial experience. As one of his colleagues put it, he was not qualified to run a hamburger stand. Yet his colleagues described him as an inspirational leader. Cohen attributes Oppenheimer's success to three capabilities. First, Oppenheimer was brilliant as a recruiter of talent. Second, he was a super communicator, long before Charles Duhigg coined that term. And third, his egalitarian streak helped foster a culture of collaboration. The second article that I commend is by John Authers. Authers has an excellent column in this week's issue of Bloomberg in which he compares the financial markets of today with the financial markets during the dot-com boom period of the late 90s and early 2000s. Cisco Systems, he tells us, was the Nvidia of that era. Like Nvidia is doing today with its graphic processing units or GPUs, Cisco Systems sold routers, metaphorically the equivalent of the picks and shovels that powered the 19th century California gold rush. The time series of the PE ratios of both companies look very similar. Both peaked at 200 before declining. The price to sales ratios where differences show up. After drifting upwards, Nvidia's price to sales ratio hit a wall in 2002, but has since resumed its climb. In contrast, Cisco's price to sales ratio never ascended after hitting a wall. Is Nvidia's spectacular sales growth sustainable? That is the question Authors asks. My third recommendation is an article by Henry Mintzberg. Mintzberg's article, 4 Forms That Fit Most Organizations, appears in the winter 2024 issue of the California Management Review. In this article, Mintzberg provides a descriptive as well as normative model for structuring and managing organizations. Real-world organizations are posited as hybrids of 4 models: the personal enterprise model, the program machine model, the professional assembly model, and the project pioneer model. Read on for how and why organizations are similar and different, and for how management and strategy ought to be different. The fourth article I refer you to is by Andrew Metrick, Professor of Finance at the Yale School of Management. In this article titled The Failure of Silicon Valley Bank and the Panic of 2023, Metrick explains why a bank run, thought to be a thing of the past, reoccurred. Silicon Valley Bank, America's 16th largest bank, had built up a thriving business by building relationships with startups, established companies, and wealthy entrepreneurs in the Bay Area and elsewhere. Much of the bank's deposits were held in long-term investment securities, whose value began to decline as the Federal Reserve began to raise interest rates in 2021 and 2022. Squeezed by higher interest rates, some clients of Silicon Valley Bank began to reduce their deposit holdings to meet their liquidity needs. On Wednesday, March 8, 2023, almost a year ago, Silicon Valley Bank announced that it had raised $36 billion from the fresh issuance of securities and loans. On Thursday, March 9th, depositors withdrew 25% of total outstanding deposits. Once it became clear to regulators that virtually all deposits would be withdrawn, they stepped in to close the bank before the end of the day Friday. The article is a dream for anyone who loves talk about balance sheets. A different kind of banking thriller than the movie The Bank Job.